Hello, and welcome to the HedgeBee Explained series. In this series, we will dive deep into the strategies of the most legendary funds on Wall Street and decode their secrets to success. In this video, we'll unveil the story of Warren Buffett's recent relationship with the tech giant Apple. What signals can we decipher from the prodigious size of Berkshire Hathaway's stake in Apple? Furthermore, how has the reputation of the Oracle of Omaha been burnished by his repurchase of Apple stock? 10 years ago, shortly before the death of Steve Jobs, Tim Cook was named Apple's CEO. Under Cook, Apple transformed into a tech juggernaut with rigorous operations and dazzling financial results. Jobs defined Apple as the world's foremost computing company through a laser-like focus on innovation and design, putting forth wildly popular products such as the iMac, iPod, iPhone, and iPad. Under Cook, Apple shored up its traditional iPhone business, scaling it up and integrating it into a seamless, comprehensive Apple ecosystem. Apple never ceases innovating. In the last decade, the company has attracted new customers and entrenched its market dominance through new products such as the Apple Watch and AirPods. The increase in earnings between the year Tim Cook was anointed Apple CEO and today highlight the sheer growth Apple has undergone in a mere decade. In the third quarter of 2011, Apple reported revenues of $28.57 billion. By the second quarter of 2021, that figure had climbed to $81.4 billion, a nearly 200% increase. iPhone revenue alone was close to $40 billion, exceeding the entirety of Apple's corporate sales when Cook took over in 2011. With a market cap of $2.4 trillion, Apple is the world's most valuable company and far ahead of its tech competitors, Amazon and Microsoft, which are giants in their own right. If an investor put $1,000 in Apple on the day Cook took the helm of the firm, their investment would be worth $16,866 by the end of August 2021. If they reinvested all dividends, the annual rate of return would exceed 32%. Few companies have produced such consistent earnings for their investors. During the same period, the annual return of the S&P 500 hovered just above 16%. In recent years, Apple has also been working to reduce its share count through repurchases. In July, Luca Maestri, Apple's CFO, remarked that since the launch of the capital return program in 2012, Apple has spent more than $450 billion on repurchases and dividends. The capital market responds well to these measures and to the strength of Apple's stock price. To some extent, these dynamics are seen as the key that has upheld the reputation of the Oracle of Omaha as one of the world's most prescient investors. The stock market crash in early 2020 forced Warren Buffett to sell off the entirety of Berkshire Hathaway's position in the U.S. airline industry. This move was later pilloried by Wall Street analysts. Prior to the crash, among Berkshire's top 5 major investments, Bank of America precipitated a loss of over $10 billion, plummeting more than 30%. Coca-Cola lost $4 billion, and American Express $5 billion. Fortunately, Apple's whopping $30 billion gains in 2020 largely offset potential damages because Buffett piled on Apple shares after dumping airline stock. Through this unusual move, Buffett did not miss the sharp rebound in U.S. stocks since May 2020 and gained even higher returns. Currently, Berkshire holds 5.6% of Apple, accounting for about 20% of its total equity portfolio. As a result, Apple's phenomenal performance resulted in Berkshire's technology stocks overtaking its financial portfolio in one fell swoop, becoming Berkshire's most important asset class. By the end of the second quarter of 2020, technology stocks comprised 38.24% of Berkshire's portfolio by value, surpassing its financial holdings of 35.22%. Apple's prominence in the Berkshire investment portfolio was not preordained. One of Warren Buffett's principles is that a central factor affecting investment value is whether a publicly listed company can set strong barriers to competition, ensure business sustainability, and generate substantial profits. In this view, rapid technological innovations have made it difficult for tech giants to establish barriers. Smarting from previous losses from Oracle and IBM, Buffett bought just 533,000 shares of Amazon, accounting for about 0.74% floating stock of the issuer. However, Buffett has since changed his mind and on many occasions has stated that Apple, once classified as a tech company, should now be considered a consumer discretionary company. As long as consumers buy iPhones, they will stick to its series of products and services. Buffett's famed buy and hold policy demonstrated its worth. Apple's status as a consumer company and its strongly sought after shares during the pandemic allowed him to achieve a comeback from earlier tech failures. The shift in Buffett's investing stance and the evolution of Berkshire's portfolio have caught the attention of investors. These shifts could be interpreted as a strategic move to keep pace with the times, but it is widely speculated that Buffett's top lieutenants orchestrated the new tech bet. The rising influence of the Berkshire lieutenants could be evidenced by Berkshire's purchase of a position in the Barrick Gold Mining Corporation in the second quarter of 2020. Now, Buffett is infamous for bashing gold as a subpar investment. By the third quarter, Berkshire slashed its position in Barrick by 40%. Such a drastic reverse over such a short period of time is noticeably out of character for the Oracle of Omaha. Historically averse to IPOs and pure tech firms, Berkshire's investment in the market debut of the cloud computing company Snowflake illustrates yet another example of uncharacteristic Buffett behavior. These investments suggest that Buffett is constantly evolving and transferring authority to his portfolio managers, even though, at present, they may have limited say. But in the long run, investors may find an increasing proportion of non-Buffett style investments cropping up in the Berkshire portfolio. These changes are eliciting mixed reactions with investors. As Buffett potentially prepares to step down, he is scaling back his control over day-to-day operations and investment decisions. It remains to be seen how the mindset and leadership strategies of the new investment managers and the dynamics of a market unfamiliar to the Oracle of Omaha will influence Berkshire Hathaway as it moves into the new decade.